Here we are. Welcome to the show, everybody. Jim Kantowski, joined as always by my colleague Jake Sadler in North Carolina. And we have a special guest with us today, Mr. Marcus Schafer, who is a vice president at one of our mutual fund ETF providers, Dimensional Funds. And we are super excited to have Marcus here today to talk about ETFs, everything you need to know about ETFs. We're going to get into a deep dive and have one of those fun conversations. And we're probably going to hear some good nuggets from Jake here that he always comes through with. And we'll make this as fun as possible. We'll get a little technical today. So welcome to the show, guys. What's happening?
I'm nervous. Marcus is on the show. I'm going to say something that I shouldn't. And I keep thinking ETF. It's not EFT. Like, this is the one that always can trip people up. Like EFT, electronic funds transfer. Not what we're talking about today. Talking about exchange traded funds, ET.
Oh my God, Jake! Now you just put that in my head. I'm going to be messing it up.
I'm just preemptively messing myself up. So, I'm not talking about electronic funds transfer.
Yeah, I should have clarified that. Exchange traded funds. Marcus, thank you so much for joining us, taking the time out of your day. I say this every time we have a podcast or a webinar or something that we do. Your value that you guys bring to our firm and your support is always amazing. So I don't know if you have an introduction you'd like to say about yourself or just want to get into the conversation.
I don't want to talk about myself. I don't think that's what the listeners have come here for. But I've been at Dimensional for almost a decade. Dimensional is one of the largest money managers in the U.S., so we're maybe seventh overall in terms of size. We manage mutual funds, we manage ETFs, we manage kind of what's been called direct indexing in the industry. So instead of buying securities through a commingled solution, that means combining your money with other investors in a mutual fund or an ETF. You can kind of go direct and get those securities. We do that as well. Super excited to talk about what is an exchange traded fund, why the popularity, et cetera, et cetera. Dimensional's probably close to 100 billion in terms of ETF AUM. So we are the largest, one of, if not the largest right now, largest active ETF issuers out there.
So, yeah, we're going to try and stay away from specific Dimensional funds information, but that's a really, really good point. Like having $100 billion in ETFs that you guys manage. And I want to point out the fact that you guys have recently sort of gotten into the business of producing ETFs and managing ETFs. And so maybe you could start there with a couple of things. Number one, describe more maybe in detail what an ETF actually is, but then just maybe what has given these products such popularity over the last several years, which has led Dimensional Funds to get into the business and to grow so quickly.
Yeah. It's a great question. I think there's this perception that an exchange traded fund and ETF is something super, super new. They've been around for a long time. They actually are regulated and kind of legislated under very, very similar rules as mutual funds. And the basic concept is you get a bunch of investors to pool money together, and then they pursue an investment strategy. And by pooling a bunch of different people's money together, you're bringing these immense economies of scale that enable portfolio managers great deals of flexibility to lower costs and bring a solution that's far, far cheaper when you pool everybody's money together than if you could do it kind of separately, person by person. So an exchange traded fund is just that. It's a pool of money pursuing an investment strategy that's well articulated, right? And then investors, what brings about the exchange traded name of it versus a mutual fund is you buy and sell them just like stocks on a marketplace, whereas a mutual fund, you're buying and selling that at the value of the underlying securities at the end of the day. So at 4 p.m., whatever the value of that pool of money is, that pool of assets, that's going to be the purchase. So it's kind of a very, very similar idea to a mutual fund. It's just let's add some flexibility to the mechanism and let's trade it throughout the day.
Yeah, it's just Jake, I'm sure you have a lot of questions after you just said that. I'm going to let you go though, because there's all kinds of places I want to dive into to get more information. So why don't you start it out?
Oh no, like Marcus, I appreciate that explanation because I mean, there's so much as you're talking to really kind of unpack. But I think what you pointed out, like similar but different from mutual funds, and maybe the ways in which exchange traded funds are different than mutual funds, offering importantly flexibility, offer some advantages to investors. Can you kind of speak a little bit more to kind of some of those differences beyond when you can transact or trade between ETFs and mutual funds, but like kind of unpack some of that flexibility that does provide some advantage to investors?
I think we shouldn't discount how they're traded in the sense of the ability for economies of scale to really come into play, because it seems very simple, but the ability to trade throughout the day might mean it's more appealing to more types of investors. And that might have implications, right? So like trading throughout the day, how custodians, so people that safeguard your money and help you transact, how they charge in a security that's traded throughout the day or a mutual fund's a little different. So there's some explicit cost savings potentially there. But one of the big enhancements around an ETF structure and commonalities where most ETFs do this, whereas most mutual funds don't, and it's not exclusive, but is around some of the ways ETFs manage securities and implications for capital gain distributions for ETFs and mutual funds. And I'm going to speak really, really broadly because these are kind of generalizations, and it really depends a little bit on investment strategy as much as the structure, but generally ETFs enable some capital gains deferrals where capital gains aren't recognized throughout the time. We generally see lower capital gain distributions for ETFs than mutual funds. And investors, obviously, I think, appreciate the ability to control tax situations based upon their and buy sell decisions, less so much in investment managers' buy and sell decisions. I'd probably ask you, how you all think about whether or not an ETF is more helpful or less helpful than a mutual fund.
So, Marcus, you're here as the expert. We're not going to allow you to turn this back on us and and get away from answering some of these very difficult questions. I'm really just kidding. That is on the horizon because we like dimensional funds. We have added ETFs to our portfolio primarily, or to our product lineup primarily for that tax efficient reason. But would you mind if we just dug a little bit deeper into two things I heard right there? Number one is the cost. I think a lot of the popularity from these ETFs is that there's this trade fee that, since it trades like an individual stock, has essentially gone away or has gotten really low in most cases. Do you think that's had an impact, number one, in terms of, the popularity? And then number two, you mentioned some other costs that may not be as visible, and maybe could you describe those a little bit more?
Yeah. So
detail.
I think what we're talking about is explicit, like costs that you can tangibly see as an investor, and then implicit costs, which are non-transparent costs that are definitely there. Like costs don't go away. They just are born in different ways. So the explicit costs, that's things like the expense ratio. It's things like transaction charges, right? So oftentimes if you go to a custodian and you buy a mutual fund, you're either paying some amount of set dollars. I'll let you all know the ranges a little bit better than me. And what we've seen is exchange traded funds and stocks. We've seen those costs kind of explicitly gone down to zero or close to zero. We're seeing some of that, I think, change a little bit in the industry. But yeah, that means that when you make a purchase, you're not instantaneously feeling $20 or $50 come out of your pocket. Now, is there a cost to trade, yes, there is a cost to transact. Otherwise, a custodian wouldn't be able to safeguard your money, right? Like there wouldn't be somebody's incentive to keep that, to make sure you get a good price, right? There's an incentivization. That's probably a good thing in the industry, is to incentivize people to help you get great costs. So what are implicit costs? These are things like the bid to ask ratio. So this is like, there's a difference between the price somebody's willing to buy and somebody's willing to sell. And in markets, there's somebody that takes those two differences and they say, I'll buy at this price and I'll sell at this price and I'll make that difference. Sometimes that difference is very close. Sometimes that difference is very large. When you're buying an ETF, that's kind of one representative example of the cost that you're bearing. It's small, it's getting small, markets are getting better, but it's still going to be there. And on large trades, it can be a very, very meaningful part of your fees. So that's one fee. There's other types of fees like that bid-ask spread and how it relates to the actual true value of the underlying securities. You might be paying at a premium to that number as well, because there tends to be more buyers of ETFs than sellers. So it makes sense that anybody selling might get a slightly more favorable price than somebody buying. That's how markets work. There has to be as many buyers and sellers. So if more people want to buy, that means sellers might get a better price until it evens out.
Yeah.
I'm going to jump on that point real fast because it might not come up again. And Marcus, you're talking about, okay, whether you're talking about a mutual fund or an exchange traded fund, investors are pooling their assets and, embarking on a kind of uniform investment strategy. And whether it's an ETF or a mutual fund, it's holding an underlying kind of basket. Let's just say of stocks, for an example, that's a strategy. I think one of the things that has come up in the past is, okay, should we be, as investors, concerned at all if there is a kind of deviation from, okay, you have this underlying basket of stocks, and you can go out on the market and just look at the individual stocks and say, okay, it's worth this amount. I know the share price for each of these, but then we see within the ETF, same basket of stocks, a different price. Like, should we as investors be concerned that there's this deviation, if you will, between the cost of the ETF per share versus the underlying basket?
I would say that that's probably representing market volatility. And anytime you're recognizing market volatility, that means uncertainty. That means prices are moving up or down dramatically a lot. Yes, you should be cautious as an investor in terms of, is now a good time to conduct that trade, recognizing you're now going to bear some of that uncertainty. And as investors, we always have this choice. Like, do I want to bear this uncertainty? You're buying stocks, so you're already choosing that you would like to bear the uncertainty of all of those different companies' cash flows. But do you really need to bear that uncertainty in the next 30 minutes? That's a really, really good question. One that I think, if you're not looking at markets every day like we are throughout the day, it's a much tougher choice than if you're kind of outsourcing that to an advisor. But when you see that uncertainty, that's kind of telling you, hey, markets are trying to comprehend what's happening. There's different investors, buyers, and sellers, and they're trying to wonder, it is now a good time to invest? And, that same person that's making that trade between the bid and the ask, if they're not as confident they're going to make money, they're going to charge more money. That should probably tell you something.
So what I'm hearing is that when the markets are more volatile, there's a lot of activity going on. That's when the bid to ask spread might be a little bit higher, and you might be willing to be a little more cautious to trade during that time frame, because you might incur these costs that you're not even aware of.
Yeah, exactly. Like if you look at March of 2020 as an example, right? We have big swings daily in prices. We have swings throughout the day. We have bid-ask spreads, the cost of kind of trading really ballooning out would be kind of the market parlance. And the question is, do you need to make that trade right then? Is there some reason that you're demanding immediacy? And there could be good reasons, like I'm sure you'll name 3 of them, right? But there's also
Sure.
this question: if you're buying something and you want to hold it for 20 years to have retirement income, maybe you don't need to trade. So that's kind of like a little more on the trading aspect, and that's always there, whether it's an ETF or a mutual fund, right? Like that's markets, that's the underlying stocks or shares of companies that are being volatile, and having a plan in place for how you're going to deal with that volatility. The easiest plan is just come back tomorrow and see if it calms down. But
So I want to get into the tax aspect that you explained it a little bit earlier, but first I wanted to ask Jake, like what Marcus just described in terms of that trading. I do think having the ability to trade throughout the day allows people to make decisions. I don't know what the right word is, maybe without really thinking through it so much. Whereas with a mutual fund, you actually have to wait till the end of the day for this product to be sold. And have you seen people react differently if they have the ability to trade during the day or sell something if they see some volatile markets?
Yeah, I mean, I think it opens up the door for questions on kind of trading strategy. Should we get a little bit more creative in how we're placing trades? Should we just place a standard market order, or should we go with a stop order, limit order, all these types of things? And I think, it does, the fact that you can trade, ETFs throughout the day, as Marcus, you were talking about, brings, some really important advantages, particularly if you're an investor that's going to hold its investments for a long period of time. At the same time, it opens the door for, I think, the ability to kind of trade and shift your mentality as an investor a little bit away from this longer term perspective, kind of narrow your focus into the here and now. And I think there are situations where that's appropriate. And I think, Marcus, you're pointing that. And there are situations where, just because you have the option to do it doesn't mean you necessarily should.
Yeah. No, I love the way Marcus was focused on that point of this long-term investing. Like if you are thinking about holding a product for a really, really long time, I mean, what does it matter if you trade it at 12 o'clock or 1 o'clock or 2 o'clock? Are you really going to make your money in that short time frame as opposed to this 20-year time frame?
But that bid-ask spread does, I mean, if we're going to talk about trading, ETFs, I think just generally as a best practice, not a hard and fast rule, but if you're talking about the market incorporating information, okay, you can look and see, okay, across the board, day to day, when is the majority of this trading volume occurring? So say beginning of the day, first couple hours, into the day, last couple hours, that sort of thing. It's at those points in time maybe where you see those bid-ask spreads as implicit costs that you'd be bearing as an investor. Those, I think, made market parlance, like you're saying, Marcus, kind of ballooning out a little bit. So maybe if you're an investor using ETFs, you want to avoid particular times of day where there's higher volume and maybe you have a higher implicit cost in transactions.
Yeah. And Marcus touched on this, and I'm going to ask him to go back to it. I think one of the real advantages to using ETFs is this tax deferral you talked about. I mean, can you give us a little bit more detail and maybe compare that to if you use a mutual fund, what it looks like from a tax perspective versus an ETF? And then Jake, maybe you can give some perspective on how it allows us as advisors to help control the cost for clients from a tax perspective.
Yeah. I'm happy to jump into it. I mean, this is one of the more complicated points, and I know we want to dive into the nuance, but we don't want to go so far where everybody now can manage their own ETF. Essentially, what's happening is ETFs, what we've seen, especially in the US and especially index tracking ETFs, their capital gain distributions have been lower than mutual fund capital gain distributions of kind of similar investment strategies. And there's some mechanisms as to why that might occur more often in an ETF versus a mutual fund. But what that enables is kind of a little bit more certainty. And as with all things like taxes, and there's some amount of uncertainty every year on how much you're going to have to pay, how much gains are realized from the portfolio. If not, the most important thing in terms of taxes, probably like how often is your portfolio turning over stocks? So what's more likely to be more tax efficient than less tax efficient? A portfolio that has very low turnover. That means there's going to be less selling of stocks at gains, which tends to mean less capital gains. Economies of scale can help here a little bit as well, right? Because now you have capital coming into the investment strategy instead of selling something and buying something else, like you might have to do in the investment strategy. You could just buy more of the thing that you wanted to buy anyways. That might help you get more on track. So it's really just a little bit more around every year there's this chance of capital gains. ETFs, what we've historically seen is that chance is smaller. That magnitude might be a little smaller. A lot of that is probably just due to investment strategy, more so than just vehicle structure, but definitely vehicle structure plays a role as well.
Just going to chime in on, these pesky capital gains distributions that, investors contend with at typically the end of each year, especially if you're investing in mutual funds. I mean, Marcus, you kind of pointed to this idea of certainty, versus uncertainty. Well, okay, when it comes to markets, we kind of deal with certain uncertainties there. But like when it comes to taxes, with mutual funds, at the end of the year, okay, if the fund itself has been buying and selling securities over the course of the year, it's accumulated, say, some capital gains. Well, it's got to get distributed out to the shareholders at the end of the year. But there's really very little ability for the actual fund shareholders to understand or know how much they're going to get distributed. What's their share going to be? What kind of capital gains are they going to get distributed out at the end of the year? You may know maybe a month in advance. You may know a couple of weeks. You may not know until it happens. So in terms of tax planning, these capital gains distributions can make that process very difficult. And it kind of comes at a time where you may be wanting to reposition the portfolio in other ways or make decisions, other tax-related decisions, and you kind of need that number and you can't get a hold of it. So with ETFs, you mentioned, okay, it's not 100% certain that we don't have these distributions, but we have a pretty, confident, we have a higher degree of confidence that we're not going to get blindsided by, an unusually high capital gains distribution. And that provides a little bit more uncertainty from the tax planning perspective.
Yeah, Jake, I mean, to your point, to Jake's point, like, so just, we're also in the tax business. And so, I was doing a tax return just yesterday, and I was looking at it from 2021. This person had mutual funds, and so their distributions in 2021 were much higher than they were in 2022, and that left a very large discrepancy in terms of what their taxes were from one year to the other. And I think it's partly because of what's happening in terms of the investment world each year, where people are withdrawing from mutual funds, could create some capital gains. Whether it's a turbulent year, more volatile, or there's actually losses that are happening where they can be minimized to some aspect. So my point is, Jake, it is really hard to manage the unknown. So it's difficult.
On a positive note, capital gains means that your portfolio, if you have to pay tax, it means your portfolio went up. So that's also something like, what are some of the primary drivers? Performance, turnover, these can make contributions, but there's definitely investment strategies that are lower cost or lower turnover, invest in a slightly more favorable structure that somebody can look into in order to really think about. And that's probably what you all are doing, right? Is analyzing, evaluating those choices to figure out. Your job is to reduce that range of uncertainty a little bit every single year so that everybody can focus on living their life, as opposed to wondering, it's March 29th. I wonder what my taxes are going to be in 8 months. That's probably not helpful.
I was just thinking, like the old adage, Marcus is talking of like, no one goes broke paying capital gains taxes. And it's just like, this idea, okay, you have capital gains, okay, yeah, portfolio went up in value. But at the same time, you can easily get focused on, okay, this is a wrench in my tax planning for the year. And so, if we can avoid any of these wrenches that can come up unexpectedly, then that could really be helpful for long-term planning and tax planning.
Yeah, I mean, I just want to add, it can be painful. Like if you had a down year, like 2022, and then you still have a large tax bill because of capital gain distributions that were completely unexpected from, a manager. And this may not even have to do so much with the structures. I think I'm getting Marcus's point. But if you have a manager out there that's created a lot of capital gains within a mutual fund that gets distributed, and that fund also went down, like that hurts a lot. In a bad year where you're taking a loss on your investments plus you're paying taxes. That is not fun, and that's where I've seen clients get pretty upset if that happens to them. And a lot of times that's why they're making changes.
I'm gonna shift gears a little bit away from this, and this is a good conversation. But like Marcus, as you've been talking, you mentioned economies of scale like a number of times as it relates to kind of ETFs operating efficiently, and I think that maybe that's something I wanted to learn more about. Kind of what do you mean there? But also kind of how does that relate to, if at all, to this growing popularity that we're seeing in the use of exchange traded funds and kind of the growth of using ETFs as a preference or vehicle versus mutual funds. So what are we seeing in terms of that growth, and has that contributed to the economies of scale that apparently benefit?
Yeah, and here I think it's something else we've kind of referenced a little bit has been, we say ETFs and mutual funds. Probably the better descriptor is passive ETFs, meaning index tracking ETFs, versus active or traditional stock picking mutual funds. And those two differences, because you could still see index mutual funds having inflows or passive mutual funds having inflows. And you can also see active ETFs having different types of flows. So I'll draw that distinction and then talk a little bit around things like economies of scale and the growing popularity. So economies of scale, if you have an investment strategy that scales at a faster rate than your costs, this tends to be index tracking or index similar type portfolios, highly diversified, rules-based, systematic. For every dollar that's in the strategy, it's not like your costs go up to the same degree because some of those are fixed costs. So if there's more money, that might mean a cheaper cost for all the shareholders to bear. That's kind of what we've seen. We've seen the fees for index tracking solutions really drop dramatically. That's put a lot of pressure on all fees in the marketplace. Great thing for investors. So with those kind of lowering of costs and economies of scale, that's really, I think, what has enabled a lot of the popularity. The other thing that's really been proven has traditional active management. It's just been shown as really, really hard to do. That means pick stocks, pick sectors, pick which country is going to do better. That is a really, really tough game to consistently get right. And when we say consistently get right, even people that have shown an ability, the best people in the world, to do it over the past 3 years, it's chance whether or not those people do it again over the next 3 years. And that's a very short time period. It feels long as investors. It's a really, really short time period for evaluating manager performance. So it's kind of this culminating factor of you see this drop in costs, and then you look at the alternatives, and as a whole, alternatives don't say that they could do better. So that's what's really driven this massive, in my mind, increase towards index tracking solutions, ETFs, big component of those as well.
Yeah, I appreciate that. Jake, I'm going to ask you, because we are pushing on this 30 minutes where we try and hold our podcast to, but I feel like we've barely scratched the surface here. So do you have anything else you want to ask Marcus about before we end the show today?
Well, probably nothing that won't last another 30 minutes.
How about 5? Anything else you want to add while we got them?
Well, I mean, one thing that we were talking about, I think to your point there, Marcus, around And Jim, to your earlier point, it's like, okay, are investors using ETFs in a different way? And then markets are kind of drawing this distinction, between active versus passive management in the kind of growing use of ETFs. I think we're also seeing kind of out there this growing interest in use of ETFs to kind of chase recent themes or recent sectors that have been doing well. And for a lot of investors, by the time these products kind of roll out onto the market, a lot of the noise is kind of fizzled out, and the kind of subsequent returns, and the evidence I think bears this out pretty well, is like subsequent returns for these kind of thematic investments don't do so well. But are we seeing kind of like in the growing popularity of ETFs, this kind of growing this increase in the number of ETFs that rolls out each year, chasing these different themes? And
we're definitely. I mean, what we're talking about is ETFs are attracting way more money than mutual funds going forward, particularly in taxable accounts. So there is this proliferation of, I'll call them strategies. I think the better word is just pure products, where whether it's a sector ETF or a country ETF, or what you're describing, a thematic ETF, right? Where, oh, hey, maybe clean energy is a sector that's being talked about really specifically. So we're going to have different ETFs that track that. To me, when I see that growing proliferation, that's just a different form of traditional active stock picking that, again, the research shows is really, really hard to do. So if you were to think 10, 20 years ago, if you have this idea that clean energy or regional banks are an investment idea that you would like to pursue, you might have had to go out there and pick different ones. That builds concentration in your portfolio. That might be a risk that, that risk is too far. But now you can go out there and purchase an ETF. Well, the whole concept behind that is it is no longer this kind of long-term expectation. It's now a shorter-term holding period. So you're going to see those solutions that are designed to attract investors over shorter holding periods. You're going to see more of those, and you're going to see more open, and you're going to see more close. And you're going to see more money chase them, and you're going to see more money get out of them. And it's just another version of something that, again, it's been really, really, it's proven hard to do. Yes, you could do it with maybe more diversification, maybe easier to trade, but I think people really need to stop and figure out, what type of investor are you? Are you trying to really invest with science, invest for the long term, or are you choosing a shorter term mentality?
Yeah, that's just such an amazing point that you just made, because to me, it just draws out one of these really fundamental distinctions that I think is emerging in the mind of a lot of investors. It's like vehicle versus strategy. And this conversation around ETFs versus mutual funds can easily shift this conversation to the vehicle, and the vehicle that matters. And then you kind of lose sight of the strategy. But I think the reality isn't in the way that we use ETFs. ETFs allow us essentially to implement the same strategy that we always wanted to implement, but we can do it more efficiently. We can create tax advantages for our clients. We can help to reduce costs for our clients. So it's not, from our standpoint, a fundamental shift in strategy. The vehicle is just offering a more efficient way to pursue the same strategy.
Did you see that excitement there? I mean, that was well said. Jake got really excited about that. And I was about to too. I'm glad you started first, because I think that I see, when you mentioned that, it's like people come to you and they're like, hey, should I invest in an ETF or should I invest in a mutual fund? And you got to stop. And it takes a while to actually step back and say, hey, what are you actually trying to accomplish? The actual products are really, really similar in nature, and you can actually use both of them to build a really, really good portfolio. And so I love the point. And I think that's actually a great place to stop, is really, we always need to step back and try and figure out what we're trying to accomplish, with our investment strategy, because we could get into fixed income and asset classes and, different types of securities, but that's it. It's really, what are we trying to accomplish? What are the best products to accomplish our strategy with?
Thanks for having me.
Final word. That's a great final word. Yeah, I appreciate it.
I would just say, nothing wrong against clean energy, just for the record, while we're still recording. I drive a Tesla. Nothing wrong with clean energy. Didn't mean to call out that sector specifically. Just goes, I think, to prove a point too. Strategy, vehicle selection. Is this something you should put your money behind, or is this something you should kind of incorporate in your life? I think are different things as well. But that was an excellent summary. Sorry to derail. Just didn't want your clients who might be listening to this be like, man, Marcus really has it out for this one subsector.
Yeah, no, we're just using examples. We want to implement people's strategies that's right for them, not what's right for us. And at Dimensional, I know you can't get into this stuff, but you have a great ESG solution that you use. So I know you guys are all about clean energy and doing what's right for the world. And so we greatly appreciate that. Jake, anything before we close?
No, that's it. I mean, I think we really kind of hit the nail there at the end. And I got really excited because, we're just drawing out this distinction between the vehicle and the strategy. And Marcus, you touched on it many times as we were talking. If you are an investor with a long-term perspective, you can choose the vehicle that is best suited and kind of most efficient for what you're trying to do. So I think we had a good conversation there and kind of hit it.
Great. Well, thank you all for joining us. As always, if you have any topics or feedback, please feel free to share them. But we've gone over our allotted time, so we'll shut it down here. Have a great day.